The stock market crash did not create the entire Great Depression in a single week, and that is exactly why the first week matters.
That may sound like a way of making the crash smaller.
It is not. It is a way of seeing its real power. The danger in late October 1929 was not only that stock prices fell.
Prices had fallen before. Markets had panicked before.
The deeper danger was that confidence, the invisible agreement holding together credit, speculation, banking, and public reassurance, suddenly looked breakable in full view of the country. Between Black Thursday and Black Tuesday, panic passed through the New York Stock Exchange in Lower Manhattan with a speed that financial leaders struggled to contain. Major banks and investment companies tried to stop the selling by buying large blocks of stock. President Herbert Hoover told the public that the fundamental business of the country was on a sound and prosperous basis. Crowds gathered around Wall Street as if the nation's economic future could be read from the doors of the exchange. And yet the Great Depression was not simply born on one terrible Tuesday. The National Bureau of Economic Research dates the American business cycle peak before the Great Depression to August 1929. That was before Black Thursday, before the most famous scenes of late October, before the phrase Black Tuesday became a shorthand for collapse. The trough came in March 1933. By that measure, the contraction lasted 43 months. So the central question is not whether the crash mattered. It did. The question is more unsettling. How did 1 week of visible panic become attached, in memory and meaning, to a much longer collapse that had already begun and would keep deepening for years? The answer begins with the difference between an event and a turning point. An event has dates. Thursday, October 24, 1929. Monday, October 28.
Tuesday, October 29.
The trading floor. The ticker. The crowds outside. The sudden effort by powerful bankers to show that they still had control. A turning point is harder to contain. It changes what people believe is possible. Before the crash, many Americans could still imagine that weakness in one part of the economy might remain limited, that speculation could cool without catastrophe, that bankers and public officials could calm a frightened market if they spoke and acted with enough authority. After that week, those assumptions were harder to hold. The first week of open Wall Street panic began on Black Thursday, October 24. It was not the first sign of trouble, but it was the day the trouble became impossible to ignore. The New York Stock Exchange became the physical center of the crisis. Lower Manhattan, already the symbolic heart of American finance, turned into a public stage for fear. A Library of Congress photograph from October 1929 shows crowds outside the exchange after the crash. The image matters because it captures something that statistics cannot fully show. People came to Wall Street not only to trade, but to watch confidence fail. Inside the market, volume overwhelmed normal expectations. On Black Thursday, 12,894,650 shares were traded on the New York Stock Exchange. That exceeded the previous record of 8,246,742 shares, set on March 26 of the same year. A trading record can sound abstract, but in a panic, it means pressure. It means orders arriving faster than the market's machinery can comfortably absorb. It means buyers and sellers looking at delayed information, trying to make decisions while the ground is moving beneath them. That is why the crash was not only a story of falling prices. It was a story of timing, trust, and visibility. Panic becomes more dangerous when people can see that others are panicking too. The financial elite understood this. On October 24, major banks and investment companies bought large blocks of stock in an attempt to stop the collapse. Federal Reserve history identifies Charles E. Mitchell of National City Bank and a coalition of bankers as participants in the effort to restore confidence through public purchases. Their action carried a message. The strongest institutions in the market were willing to stand behind it. For a moment, that kind of performance still seemed plausible. In the world of finance, confidence is not decorative. It is part of the structure. If investors believe that powerful banks will support prices, they may stop selling. If they stop selling, prices may steady. If prices steady, the appearance of stability can become stability itself. But that logic has a weakness. It works only if people believe it. The following day, October 25, President Herbert Hoover offered his own reassurance. He said that the fundamental business of the country was on a sound and prosperous basis. The statement was meant to separate Wall Street panic from the broader economy, to tell Americans that falling stock prices did not mean the nation's productive life had collapsed. But even in that reassurance, there was tension. Hoover also acknowledged that building and construction had been affected by high interest rates induced by stock speculation. That sentence pointed toward the machinery behind the panic. The market was not floating above the economy, detached from banks, credit, construction, and business decisions. Speculation had helped pull money into Wall Street. High interest rates had consequences beyond the exchange. The line between a stock market panic and a broader economic strain was not sealed. Still, the severest banking panics associated with the Depression did not begin that week. That distinction is essential. Federal Reserve history identifies November 1930 to August 1931 as the first major banking panic period. The runs, failures, and fear that would later move through banks across the country belonged to a later phase of the crisis. They were not already fully present in the crowds outside the New York Stock Exchange in October 1929. But the first week helped teach the country a frightening lesson. Confidence could disappear in public. On Black Monday, October 28, the attempted restoration of calm broke again. The Dow Jones Industrial Average fell nearly 13%. This mattered because it showed that Black Thursday had not been merely a one-day shock. The bankers' intervention had not ended the danger. Official confidence had not settled the market. The selling had resumed with historic force. Then came Black Tuesday, October 29, when the Dow fell nearly 12%. In later memory, that day often stands for the crash as a whole. It became the sharp symbolic edge of a longer unraveling. But even here, precision matters. Black Tuesday was not the end of the Depression's beginning. It was one moment in a contraction that the National Bureau of Economic Research had already dated from August, and that would not reach its trough until March 1933. The market itself would keep showing how deep the damage was. By mid-November 1929, the Dow had lost almost half of its value from before the late October collapse. Later, in the summer of 1932, it would fall to 41.22, 89% below its peak. It would not return to its pre-crash height until November 1954. Those later figures are reminders that the first week did not end when the calendar moved on. It continued as memory, as caution, as loss, and as a new way of reading economic news. After late October, a decline was no longer just a decline. A bank statement was no longer just a bank statement. A reassurance from Washington no longer carried the same automatic force. The public had seen that confidence could be staged by bankers, defended by presidents, and still fail. This is the thread that runs through the whole crisis. The crash began as a visible collapse in Wall Street prices, but the Depression became devastating when fear traveled into other systems of trust. A person who distrusts a stock may sell it. A person who distrusts a bank may try to withdraw cash immediately. That later movement, from stockholders' fear to depositors' fear, would prove far more destructive. But in the first week, the drama was concentrated in Lower Manhattan. The New York Stock Exchange was the stage. The ticker and the trading volume were the signals. Charles E. Mitchell and other bankers represented the effort to manufacture confidence. Hoover represented the official insistence that the country's basic business life remained sound. The crowds outside represented something less organized and more powerful, the public trying to understand whether the people in charge still understood the danger. The first week of the crash was not the whole Great Depression. It was not even the full beginning of the downturn, but it was the moment when a financial panic became a national lesson in broken confidence. To understand why that confidence was so fragile, we have to look beneath the noise of the trading floor, to the boom that came before the bell, brokers' loans, margin accounts, and the billions of dollars that had been drawn from banks into Wall Street before the panic ever became visible. Before the panic became a crowd, before it became a photograph outside the New York Stock Exchange, before it became Black Thursday, it was already present in the machinery of the boom. It lived in loans. It lived in accounts. It lived in the quiet movement of money toward Wall Street. The late 1920s are often remembered through their surfaces: rising prices, confident talk, a sense that the market had become a public staircase, always leading upward. But beneath that confidence was a structure that made the rise more fragile than it appeared. The structure was not mysterious. It was built from familiar parts of the financial system: brokers' loans, margin accounts, and bank credit flowing into the stock market. A margin account made it possible to buy stock without paying the full price in cash. An investor could put up only part of the money and borrow the rest. The stock itself became collateral for the loan. As long as prices rose, this arrangement could feel not only safe, but almost self-confirming. A rising market made the collateral look stronger. Stronger collateral made more borrowing feel possible. More borrowing helped carry more shares. More shares carried on borrowed money fed the sense that the boom had depth. But that depth was partly borrowed. This is why margin buying mattered so much in the crash. It was not just a way to participate in the market. It was a way to make the market more sensitive to falling prices. If a person owned stock outright, a decline might be painful, but it did not automatically force an immediate sale. In a margin account, the situation was different. When prices fell, the value of the collateral fell with them. The borrower could be required to produce more cash. If that cash could not be found, the stock could be sold. A falling price could therefore create selling pressure, not only because people were afraid, but because the credit arrangement itself demanded action. This was the hidden machinery of panic, a system in which falling prices could turn into forced selling, and forced selling could push prices lower still. The research record gives us a sense of scale. Britannica reports that in midsummer 1929, roughly 300 million shares of stock were being carried on margin. That figure matters because it shows that margin was not a small side practice at the edge of the market. It was woven deeply into the speculative boom. Millions of shares did not simply represent ownership. They represented ownership connected to borrowed money, to collateral values, and to the expectation that prices would remain high enough to keep the whole arrangement stable. The boom depended on confidence, but not in the vague sense of optimism alone. It depended on a specific chain of confidence. Banks had to be willing to see Wall Street as an attractive place for funds. Brokers had to be able to borrow. Investors had to be willing to hold stocks through margin accounts. Everyone in that chain had to believe, or at least behave as if they believed, that the market could keep supporting the credit built upon it. During the late 1920s, billions of dollars were drawn from banks into Wall Street to finance brokers' loans carrying margin accounts. That sentence is easy to pass over, but it describes one of the essential movements behind the first week of the crash. Money that might have remained in banks or moved through other channels of ordinary business was pulled toward the stock market because speculation offered a powerful attraction. Wall Street did not merely collect enthusiasm, it collected credit. Brokers' loans were the link. A broker helped finance the customer's margin account. To do that on a large scale, brokers needed funds. Banks supplied those funds through loans and correct payments. The money then helped carry stocks bought on margin. In this way, the banking system and the stock market were connected before the banking panics of the early 1930s began. This does not mean that the severe banking panics were already underway in late October 1929. They were not. But it does mean that bank credit was already part of the speculative structure that made the Wall Street panic so dangerous. The distinction is important. The first week of the crash was not yet the later crisis of depositors rushing to remove cash from banks. That phase would come later. But the crash did expose a link between the public world of stock prices and the less visible world of credit. A collapse on the exchange could not remain only a matter of paper wealth when so much of that paper wealth had been carried with borrowed money. The speculative boom had created a kind of confidence that looked broad, but could narrow very quickly. When prices were rising, a margin account allowed investors to control more stock than their cash alone would have permitted. That made gains feel larger. It made participation feel easier. It also made the market appear more liquid and active. But the same mechanism worked in reverse. When prices fell, the investor's cushion was thin. The need for cash could arrive suddenly. The choice could disappear. The account that had expanded opportunity on the way up could enforce discipline on the way down. That is why the late 1920s cannot be understood only as a story of people believing too much. It was also a story of how belief was financed. Optimism took institutional form. It moved through banks into brokers' loans. It appeared in margin accounts. It was counted in shares carried with borrowed money. It connected private decisions to a larger structure of risk. And because the structure was built around market prices, it was vulnerable to a change in those prices. If the value of collateral depended on the market's judgment, then a shift in the market's judgment could weaken the collateral. If weakened collateral led to demands for more cash, then the search for cash could lead to sales. If sales pushed prices down further, then the weakening could spread. This is where confidence stopped being merely psychological. It became mechanical. By the time the first week of open panic arrived, Wall Street was not a calm place suddenly invaded by fear. It was a market already carrying an enormous weight of speculation. The billions of dollars drawn from banks into Wall Street had helped support the boom. The brokers' loans had helped carry the margin accounts. The margin accounts had helped carry the shares. And those shares, roughly 300 million of them on margin in midsummer 1929, according to Britannica, stood as a measure of how much of the market's apparent strength rested on borrowed support. None of this means that every investor understood the full chain. A person watching prices rise did not need to see the entire system to participate in it. That was part of the danger. The visible market was simple. Prices moved, quotations appeared, fortunes seemed to grow. The invisible market was more demanding. Loans had terms, collateral had values, and credit had limits. When confidence was intact, those limits could be ignored. When confidence broke, they became unavoidable. The first week of the crash would make that break visible. Crowds would gather. Trading volume would overwhelm the usual rhythms of the exchange. Reports would lag. Bankers would try to steady the market through public purchases. Officials would speak in the language of reassurance. But the panic did not begin with the crowd outside. It began in a structure that had allowed fear to become self-feeding once prices started to fall. The boom beneath the panic was therefore not separate from the crash. It was the condition that made the crash so powerful as a public event. The market had not only risen, it had been carried upward by borrowed money. When the turn came, the fall carried more than prices with it. It carried the credibility of a financial arrangement that had seemed, for a time, to turn credit into prosperity. Soon, that hidden arrangement would move into public view. The abstract language of brokers' loans and margin accounts would be replaced by streets, buildings, police lines, faces, and a crowd trying to read the meaning of a financial collapse from outside the doors of the New York Stock Exchange. Wall Street would become the stage on which a private structure of speculation turned into a national crisis of confidence. The machinery of speculation had been built in accounts and loans, but the public could not see an account. It could not see a broker's loan moving through the financial system. It could not see margin as a line of pressure tightening around an investor. What the public could see was Wall Street. By late October 1929, the abstract structure of the boom had a physical address. It was in Lower Manhattan, in the streets around the New York Stock Exchange, in the financial district, where the language of credit and collateral became noise, motion, and waiting. The crisis did not belong only to that neighborhood. Its causes and consequences reached far beyond New York City. But in the first week of open panic, Wall Street became the visible stage. That visibility mattered. A market panic is partly a movement of prices, but it is also a movement of belief. People try to read one another. They look for signs. They ask whether someone else knows more than they do. When confidence begins to fail, the place where information is supposed to be gathered becomes a place where anxiety gathers too. The New York Stock Exchange stood at the center of that anxiety. It was not simply a building where shares changed hands. In the public imagination, it was the place where the prosperity of the late 1920s had been measured, celebrated, and now doubted. The exchange gave the crisis a front door. It gave newspaper readers and bystanders a location they could picture. It gave the fall in prices a scene. One of the most important images from that moment is preserved by the Library of Congress, a photograph of a crowd outside the New York Stock Exchange following the 1929 crash. The photograph does not explain brokers' loans. It does not calculate margin requirements. It does not show the inside of a bank or the balance sheet of an investment company. Its power is simpler than that. It shows people gathered outside the institution that had come to represent the market itself. In a crisis of confidence, a crowd is never just a crowd. It is evidence that private fear has become public. Each person may have arrived with a different question. Some may have had money in the market. Some may have known someone who did. Some may have come because the street itself had become news. But together they formed a visible measure of uncertainty. They were outside, looking toward a system whose decisions were taking place inside. That separation is important. The trading floor of the New York Stock Exchange was not the same as the street outside it. Orders were being executed inside. Prices were being made inside. The formal mechanisms of the market belonged inside the exchange. But the meaning of those prices escaped the walls almost immediately. It moved outward into the surrounding financial district, into conversations, into headlines, into rumor, into the faces of people who understood that something important was happening, even if they could not see the trades themselves. The photograph helps us hold on to that distinction. It is not a picture of the crash as a set of numbers. It is a picture of the crash as public experience. It reminds us that the first week was not only a sequence of market days. It was also a transformation of atmosphere. Wall Street became crowded because the market had become a public question. Was prosperity real? Were fortunes secure? Were banks, brokers, and business leaders still in control of the forces they had helped set in motion? The answer was not yet clear. That is part of what gives the first week its tension. In late October 1929, the country had not yet experienced the later banking panics that would deepen the Depression. The severe banking panic period, identified by Federal Reserve history, would come later, beginning in November 1930. The crowds outside the exchange were not yet the same as depositors lining up to demand cash from banks across the country. This was a different stage of fear. It was concentrated first around Wall Street, around stocks, around the institutions that had carried the speculative boom. But even at this early stage, the fear was larger than the market. Wall Street was where the panic could be seen, but the worry it represented was already national in implication. The late 1920s had drawn billions of dollars from banks into Wall Street to finance brokers' loans carrying margin accounts. That meant the market was not sealed off from the broader economy. When people looked at the exchange, they were not only looking at stock prices. They were looking at a financial arrangement that had connected borrowed money, rising shares, banks, brokers, and ordinary confidence in the future. The location made that arrangement feel real. Lower Manhattan had long been a district of institutions, buildings, and routines. In ordinary times, those routines could suggest stability. The exchange opened. Orders moved. Prices changed. Banks and investment firms conducted business in the surrounding streets. But during the first week of the crash, the same concentration of financial power created a different impression. Instead of stability, the district suggested exposure. If confidence failed there, in the place most identified with financial command, what did that say about confidence elsewhere? This is why the crowds mattered as much as they did. The people outside the New York Stock Exchange could not force prices up or down simply by standing there. They were not the machinery of the market. Yet they were part of the crisis because confidence depends on shared expectations. When people gather outside a financial institution in alarm, they create an image that others can see and interpret. The crowd becomes a signal. It says that uncertainty is no longer hidden in ledgers or whispered in offices. It has stepped into the street. There is a quiet drama in that. The panic was not yet fully understood, even by the people living through it. No one standing in Lower Manhattan in late October 1929 could know the full path of the contraction that the National Bureau of Economic Research would later date from August 1929 to March 1933. They could not know how far the Dow Jones Industrial Average would eventually fall, or how long it would take to return to its pre-crash height. They could only experience the uncertainty of the present. And the present was full of signs that something had gone wrong with the system of reassurance. In the boom, rising prices had seemed to confirm themselves. Prosperity had been visible in gains. Credit had seemed to support opportunity. Margin accounts had allowed investors to participate with borrowed money. But when prices weakened, the same mechanisms produced doubt. The public did not need to understand every technical link to sense the danger. The presence of crowds outside the exchange showed that the market's internal trouble had become a public spectacle. Wall Street, then, was not just a backdrop. It shaped the way the crisis was understood. A panic in a distant ledger might remain abstract. A panic at the New York Stock Exchange could be photographed. It could be described. It could be watched from the street. The architecture and geography of finance turned the collapse of confidence into a scene people could remember. The Library of Congress photograph gives us one grounded way to see that scene without exaggerating it. It does not tell us that every American was standing there. It does not turn the first week into the whole depression. It does not collapse the later banking crisis into the stock market crash. Instead, it fixes attention on a more precise truth. In October 1929, the public face of financial fear was concentrated outside the exchange in Lower Manhattan. That public face would become more intense as the week unfolded. The street was waiting for information, and information itself was about to become part of the panic. The exchange could open its doors and process orders, but the volume of those orders would soon strain the market's ability to tell people what was happening in real time. Anxiety outside the building would be matched by pressure inside it. The stage had been set. Wall Street, the New York Stock Exchange, the surrounding financial district, and a public trying to read confidence through a crowd. Then came Thursday, October 24, 1929, when the market's own instruments began to fall behind the fear they were supposed to measure. The street was waiting for information, and on Thursday, October 24, 1929, information began to lose the race. That day would become known as Black Thursday, the first widely recognized panic day of the crash. It did not create the whole depression. It did not begin the economic contraction that the National Bureau of Economic Research dates from August 1929. But it gave the crisis a public form. It turned weakening prices, private anxiety, and strained credit into something visible, measurable, and frightening. The place was the New York Stock Exchange in Lower Manhattan. The stage had already been set by the crowds outside, by the financial district's narrow concentration of banks, brokers, and newspaper attention, and by the public sense that Wall Street was no longer merely a place where fortunes were made. It was becoming a place where confidence itself could be watched under pressure. On Black Thursday, the pressure became volume. According to the records cited in the research notes, 12,894,650 shares were traded on the New York Stock Exchange that day. The number mattered not simply because it was large, but because it broke through the known limits of recent experience. The previous record had been 8,246,742 shares, set on March 26, 1929. That earlier record had already suggested the force of speculation in the market. By October, it looked almost modest. Black Thursday exceeded it by more than 4 million shares. In a market where each trade represented a decision, a fear, a forced sale, a hope, or an attempt to escape loss, the total gave panic a numerical shape. The exchange was not just moving through a difficult day. It was being overwhelmed by the desire to sell, buy, cover, liquidate, and know what was happening all at once. This is why the trading volume is central to the story. A market panic is sometimes described as if it were only a fall in prices. But on Black Thursday, panic also appeared as congestion. It appeared as orders moving faster than the system's ability to report them. It appeared in the lag of the ticker, the machine that was supposed to translate the action of the exchange into a steady stream of information. The ticker was more than a device. It was part of Wall Street's nervous system. It carried prices outward from the exchange to brokers' offices and investors who depended on its sequence of symbols and quotations. In ordinary times, it helped make the market feel legible. It suggested that prices, however changeable, could be followed. It gave people the comfort of order. A trade happened, a quotation appeared, a decision could be made. On Black Thursday, that comfort weakened. When volume rose beyond previous records, the reporting machinery fell behind the trading itself. The ticker no longer delivered the present. It delivered the recent past. In a calm market, a delay might have been an inconvenience. In a panic, delay became a source of fear. If the price on the tape was already old, then the investor reading it did not know where he stood. A stock that appeared to have one value might already have another. A decision made from the tape might be made too late. That was one of the day's quiet terrors. The market was still functioning, but confidence in the flow of information was breaking down. People were not only afraid of what prices had done, they were afraid of what prices might already have done before they could see it. This made panic visible in a way that a list of declining stocks could not. The record volume showed that the market was being flooded by action. The lagging ticker showed that the action could not be fully absorbed in real time. Together, they revealed a crisis of trust and timing. Wall Street depended on the belief that information could travel quickly enough to guide judgment. On Black Thursday, that belief faltered. For people outside the exchange, the meaning was harder to separate from rumor and appearance. They could see crowds. They could see the financial district filling with attention and anxiety. They could understand, even without knowing every quotation, that something unusual was happening inside the building. The crowd outside the New York Stock Exchange, captured in the Library of Congress photograph from the period, belongs to that broader public image of uncertainty. It shows people gathered near the center of finance, not because they could fix the market, but because they wanted to be close to the source of news. Inside and outside, the same problem took different forms. Inside, the exchange faced the mechanics of unprecedented trading. Outside, the public faced the emotional burden of not knowing what the mechanics meant. The more the market strained, the more the crowd mattered. People watched other people watching. Anxiety became social. Fear could spread not only through prices, but through faces, movement, and the knowledge that others were afraid too. The comparison with March 26 is important because it reminds us that Black Thursday did not arrive in a world unfamiliar with heavy trading. The market had already seen enormous activity earlier in the year. The late 1920s had already drawn billions of dollars from banks into Wall Street to finance brokers' loans carrying margin accounts. Britannica reports that, by midsummer 1929, roughly 300 million shares were being carried on margin. The system was already large, leveraged, and sensitive to falling prices. But Black Thursday made the strain public. The record did not describe hidden credit in the banking system. It described a visible surge at the exchange. It was a number that could be printed, repeated, and understood as evidence that something exceptional had happened. 12,894,650 shares became more than a statistic. It became a sign that the market's ordinary scale had been surpassed. That scale shaped behavior. If investors believed others were selling, waiting became dangerous. If prices were falling and the ticker was late, patience could look like risk. If margin accounts were under pressure, falling prices could force more selling, not because every investor wanted to sell at that moment, but because the structure of credit demanded cash or liquidation. The fear of loss and the mechanics of leverage worked together. This is why Black Thursday stands at the center of the first week's story. It was not the largest fall, still to come in the Dow Jones Industrial Average. Black Monday and Black Tuesday would bring their own historic declines. But Black Thursday revealed the fragility of confidence in a particular way. It showed that the market could be overtaken by its own volume. It showed that information could lag behind events. It showed that a financial system built on confidence could begin to feel unsteady even before the full damage was known. The day also exposed a deeper contradiction. Wall Street depended on speed, credit, and belief. The faster the market moved, the more investors depended on accurate information. The more investors depended on borrowed money, the more falling prices could force immediate decisions. The more immediate the decisions became, the more the market needed calm. But calm was exactly what was disappearing. By the end of the day, Black Thursday had given the panic a name and a record. The New York Stock Exchange had traded more shares than ever before. The previous record from March had been left far behind. The ticker had fallen behind the market it was meant to report. And the public had seen, in the crowding of Wall Street and the strain of the exchange, that confidence could fail not as an abstract idea, but as a sequence of delayed prices, crowded sidewalks, and orders too numerous to absorb. Yet even then, many powerful figures still believed confidence could be restored if it was performed visibly enough. If fear could spread through crowds and quotations, perhaps reassurance could spread the same way. On Black Thursday, as the market's machinery strained under record volume, major banks and investment companies prepared to make that belief public by buying into the panic. The panic had become visible before the bankers acted. It was visible in the crowds outside the New York Stock Exchange, in the delayed ticker, in the record volume of orders, and in the sense that prices were no longer simply falling, but falling faster than the market's own language could explain them. By midday on Thursday, October 24, 1929, the problem was no longer just a problem of valuation. It was a problem of belief. That was why the response had to be public. On Black Thursday, major banks and investment companies bought large blocks of stock in an attempt to stop the panic. Federal Reserve history identifies Charles E. Mitchell, the president of National City Bank, now Citibank, as one of the bankers involved in the effort. It also describes a coalition of bankers who tried to restore confidence through public purchases of stock. The word public matters here. These were not quiet adjustments inside a ledger. They were not private conversations about the long-term strength of companies. They were meant to be seen. The bankers were trying to send a message into a market that seemed to be losing its capacity to hear ordinary reassurance. If investors believed that the strongest financial institutions were willing to buy when others were desperate to sell, perhaps the selling would slow. If the public saw that powerful bankers were still willing to put money into the market, perhaps panic would begin to look irrational rather than contagious. In ordinary times, a purchase is just a transaction. On Black Thursday, it was meant to become a statement. The logic was simple, and it belonged to the world that had produced the boom itself. Through the late 1920s, Wall Street had depended on credit, confidence, and the assumption that rising prices could justify the risks taken to buy into them. Brokers' loans and margin accounts had connected bank credit to speculation. Billions of dollars had moved from banks into Wall Street to finance stock purchases. Britannica reports that by midsummer 1929, roughly 300 million shares were being carried on margin. That meant the market had been built not only on ownership, but on borrowed belief. Investors had borrowed to buy. Lenders had accepted stocks as collateral. Rising prices had made the arrangement seem secure. But when prices fell, the same machinery worked in reverse. Collateral weakened. Margin accounts came under pressure. Investors who could not supply more cash faced forced selling. Selling pushed prices lower, and lower prices created still more pressure. By Black Thursday, the question was whether this spiral could be interrupted before it became self-feeding. The bankers' intervention was an answer to that question. They were not trying to rebuild the economy in a day. They were trying to stop a run on confidence. Charles E. Mitchell was an important figure in that world because National City Bank was not a small or marginal institution. It stood close to the center of American finance. His participation signaled that leading bankers understood the danger of what was happening on the exchange. Their concern was not only that individual investors might lose money, it was that panic itself might become the dominant fact. In a market panic, prices can become messages. A falling price tells the next seller to sell quickly. A delayed ticker tells the public that the machinery is overwhelmed. A crowd outside the exchange tells passers-by that something larger than a normal trading day is underway. The bankers tried to insert a different message into that chain. Their purchases said, "There is still money here, there is still support, there are still institutions willing to buy." This was confidence as performance, but not performance in the sense of something meaningless. In finance, performance can have real effects. A visible act can change expectations. If enough people believe that a floor has been placed under prices, some may stop selling. If enough sellers pause, the pressure may ease. If the pressure eases, the appearance of stability may become a kind of stability. For a time, that was the hope. The intervention also revealed how the country still thought about financial rescue in 1929. The Federal Reserve existed, but its leaders were divided over how to respond to speculation and the crash. The United States had a young central banking system, and it had not yet settled the boundaries between restraining speculation and supporting markets under stress. In that setting, the public leadership of private bankers carried a particular weight. Wall Street still looked, in moments of emergency, to the authority of large banks and investment houses. The bankers' coalition was therefore trying to do more than buy shares. It was trying to prove that the financial elite still had command of events. But command is not the same thing as control. The scale of Black Thursday made the intervention difficult from the start. The New York Stock Exchange traded 12,894,650 shares that day, far above the previous record of 8,246,742 shares set on March 26, 1929. The sheer volume mattered because panic was not moving through one or two weak stocks. It was moving through the market as a system of expectations. Buyers could support selected shares, but they could not easily erase the fear created by hours of selling, delayed information, and crowded uncertainty. The bankers were trying to slow a collapse whose deeper causes had been accumulating for years. The speculative boom had drawn billions of dollars from banks into Wall Street. Margin buying had allowed investors to control more stock than they could purchase outright. Rising prices had made risk look manageable. But once prices began to fall sharply, the same credit structure made fear more urgent. A person who owned stock outright could wait if they had the nerve and the resources. A person buying on margin might not have that choice. So the bankers' purchases had to fight both psychology and mechanics. They had to persuade people that the fall was over, while the market's credit arrangements were still forcing some investors to sell. They had to make confidence visible at precisely the moment when the visible evidence of the day pointed in the other direction. This is why the episode is so revealing. The banker's intervention did not fail because it was irrational. It followed a recognizable theory of panic. If fear spreads through signals, counter-signals might stop it. If selling creates selling, buying might create buying. If the crowd believes that respected institutions are stepping in, the crowd may change its behavior. But the intervention also showed the limits of reassurance when the underlying structure had been strained. A public purchase could suggest strength. It could not undo all the loans behind the boom. It could not remove the pressure from every margin account. It could not make the ticker catch up or restore every investor's trust in the prices appearing after long delay. It could not resolve the question that Black Thursday had raised in public. What were stocks really worth if so many people wanted to sell at once? The answer, for the moment, was uncertain. That uncertainty explains why Black Thursday could appear, briefly, as both a crisis and a rescue. The day had opened into panic. Then the bankers entered the scene, and their buying gave the market a visible point of resistance. For observers who wanted to believe that the break had been contained, the intervention offered something to hold on to. It suggested that Wall Street's most powerful institutions would not simply stand aside while prices collapsed. Yet the need for such a rescue also carried its own warning. If confidence were truly firm, it would not require a coalition of bankers to demonstrate it. If the market were naturally stable, it would not need visible support from major banks and investment companies. The public purchases were meant to reassure, but they also confirmed that the danger was serious enough to demand extraordinary action. This was the contradiction at the heart of the day. The bankers stepped in to show strength. Their very presence revealed weakness. For the public, the scene was difficult to interpret. Outside the New York Stock Exchange, people could see crowds, movement, anxiety, and the physical signs of a market under pressure. Inside the financial district, the names of major institutions still carried authority. A person reading about the bankers' support might take comfort from it. A person watching the panic unfold might wonder why such support had become necessary at all. The crash's first week was becoming a struggle over interpretation. Was Black Thursday a temporary break in a fundamentally sound economy? Was it a needed correction after speculation had gone too far? Or was it evidence that the credit and confidence of the late 1920s were more fragile than they had appeared? The bankers had one answer. Their answer was action. Buy into the falling market, visibly and in size, and let the act itself speak. But confidence, once damaged, does not always return on command. It may pause. It may watch. It may accept reassurance for an afternoon and reject it later. The intervention on Black Thursday mattered because it showed that powerful institutions recognized the danger and tried to halt it. It also mattered because the effort did not end the fear that had been released. By the close of that day, Wall Street had not simply witnessed panic. It had witnessed an attempt to manage panic through the authority of private finance. Charles E. Mitchell and the bankers identified by Federal Reserve history became part of a larger drama in which buying stock was meant to serve as a public declaration. The market could still be trusted. But the country was already moving toward another kind of reassurance. If Wall Street's bankers could speak through purchases, Washington would soon speak through official language. On Friday, October 25, 1929, President Herbert Hoover would offer his own statement of confidence, insisting that the fundamental business of the country rested on a sound and prosperous basis, even as the strain caused by speculation was becoming impossible to ignore. The bankers had tried to speak in the language Wall Street understood: purchases, visible confidence, orders placed in the market at a moment when fear seemed to be running ahead of judgment. But reassurance did not belong only to the financial district. By Friday, October 25, 1929, the day after Black Thursday, another voice entered the crisis from Washington. President Herbert Hoover issued a statement on the national business and economic situation. Its most remembered line was meant to separate the stock market panic from the wider American economy. Hoover said that the fundamental business of the country was on a sound and prosperous basis. The phrase was not accidental. It was a presidential attempt to draw a boundary around fear. Wall Street had been shaken. Stock prices had fallen. Trading had become so heavy on Black Thursday that the market's own machinery struggled to keep pace. But Hoover's message was that the country itself was not collapsing. Business, in his framing, remained fundamentally strong. That distinction mattered because the panic of late October was, at first, a crisis of confidence centered on the New York Stock Exchange and the financial district around it. It had not yet become the later banking emergency that would spread through deposits, withdrawals, and bank failures. The severe banking panics associated with the Depression would come later. Federal Reserve history identifies November 1930 to August 1931 as the first major banking panic period. On Friday, October 25, 1929, the nation was still in a different moment, shaken by a market crash, but not yet living through the full banking collapse that would define the worst years of the Depression. Hoover's statement tried to hold that line. It is easy, with the knowledge of what followed, to hear the phrase sound and prosperous basis as tragically misplaced. But in the first week of open panic, it had a specific purpose. A president could not repair the ticker. He could not personally stop forced selling on margin accounts. He could not erase the fact that billions of dollars had been drawn from banks into Wall Street to finance brokers' loans carrying speculative positions. But he could try to affect the public interpretation of those facts. He could argue that the market was not the same thing as the nation. That was the reassuring half of the statement. The other half was more revealing. Hoover also acknowledged that building and construction had been affected by high interest rates induced by stock speculation. That admission complicated everything. It meant that even as the president insisted on the country's sound and prosperous basis, he recognized that speculation had already reached beyond stock prices. It had touched construction. It had influenced interest rates. It had placed pressure on a real sector of the economy, one made not of quotations on a board, but of materials, labor, buildings, contracts, and future plans. This was the tension at the center of Hoover's Friday statement. The fundamentals, he said, were sound. Yet, one of the most visible forms of economic activity, building and construction, had been affected. The country was prosperous, he suggested, but speculation had helped create high interest rates, and those rates had already done damage. That tension tells us why the first week of the crash was not just a story of falling securities. It was a story about how confidence moves across boundaries. The stock market could be described as separate from ordinary business, but the mechanisms behind the boom made separation difficult. Brokers' loans and margin accounts were not isolated abstractions. They drew money toward speculation. They helped carry shares whose ownership depended on borrowed funds. Britannica reports that in midsummer 1929, roughly 300 million shares were being carried on margin. Behind those shares was credit. Behind that credit were institutions and expectations. And when speculation helped pull money into Wall Street, interest rates could rise in ways that affected other activity. Hoover's acknowledgement of building and construction made that connection visible. Construction is an especially important detail because it gives the listener something concrete to hold. A falling stock price can seem remote, especially to those who did not own shares. But construction meant projects that might be delayed, loans that might be more expensive, employers who might hesitate, and communities that might notice the absence of work. It pointed toward the wider economy without claiming that the full depression had already arrived. In this sense, Hoover's statement was both a reassurance and a warning, though it was not framed as a warning. It tried to calm the country by saying that basic business conditions remained strong. But inside the same message was evidence that the speculative fever of the late 1920s had strained more than the stock exchange. The president's own words showed that Wall Street's boom had consequences beyond Wall Street. That is what makes October 25 so important in the emotional history of the crash. On Black Thursday, panic had been visible in crowds and trading volume. The banker's intervention had been visible in large purchases meant to steady the market. On Friday, reassurance became verbal and official. Washington stepped into the crisis not with a trading order, but with a sentence. The sentence was designed to be stabilizing. It told business leaders, investors, workers, and newspapers that the government did not see the panic as proof of national ruin. It suggested that the real economy still had strength beneath the market's violence. And for a public trying to understand whether the crash was a passing storm or the beginning of something larger, that distinction mattered. But public confidence is not restored by wording alone. It depends on whether experience confirms the message. If people saw their brokerage accounts collapse, if they heard that the ticker had fallen behind, if they knew that stock purchases by powerful bankers had been needed to stop a panic, then the president's reassurance had to compete with what the week had already shown them. The official language pointed toward stability. The visible evidence pointed toward fragility. That competition between language and experience would shape the days that followed. Hoover was not alone in believing that confidence could be protected by public signals. The bankers had acted on the same assumption the day before. Charles E. Mitchell of National City Bank and the coalition identified by Federal Reserve history had participated in an effort to restore confidence through public purchases of stock. Their intervention was not only financial, it was theatrical in the older sense of the word. It was meant to be seen. It was meant to communicate strength. Hoover's statement performed a related function from another seat of authority. It reassured by naming the country's business basis as sound and prosperous. It tried to stop the meaning of Black Thursday from expanding too quickly. It said, in effect, that a market panic did not equal a national collapse. Yet, the words also carried the seeds of doubt. If stock speculation had induced high interest rates, and those high interest rates had affected building and construction, then the market and the wider economy were already connected. The damage might be limited, but it was not imaginary. The president's own statement conceded that point. This is why the phrase has lasted. It captures the official confidence of the moment, but also its limits. Sound and prosperous was meant to calm. In retrospect, it sounds like the last language of an old assumption that prosperity beneath the surface would absorb the shock above it. But on October 25, 1929, no one yet knew the full path ahead. The Dow Jones Industrial Average had not yet suffered the nearly 13% fall of Black Monday or the nearly 12% fall of Black Tuesday. The later banking panics had not yet begun. The long contraction that the National Bureau of Economic Research dates from August 1929 to March 1933 was underway, but its full severity was not yet visible to the public in late October. So Hoover's statement belongs to a narrow and uneasy interval. It came after the first great day of open panic, after the bankers stepped in, after the market revealed how quickly confidence could fail. But it came before the next violent breaks that would make the crash historic. It stands in the pause between shock and deeper shock. In that pause, Americans were asked to believe that the country's foundation was stronger than the market's panic suggested. They were also given a reason to worry that speculation had already distorted the flow of credit into ordinary business. Reassurance and weakness appeared in the same statement, not as opposites, but as the two halves of the national mood. By the end of Friday, the country had heard from Wall Street's bankers and from the President of the United States. Both had tried, in different ways, to steady confidence. Both had treated confidence as something that could be influenced by public action. But neither could erase the uncertainty waiting beneath the weekend. The market had been steadied, not healed. The President had reassured, not proved. And as the trading week gave way to Saturday and Sunday, the question was no longer only what had happened on Black Thursday. It was whether the calm that followed could survive the next opening bell. The pause after Friday did not feel like certainty. It felt like a held breath. By the end of October 25, 1929, the country had been offered two kinds of reassurance. In Lower Manhattan, major banks and investment companies had tried to show strength by buying large blocks of stock into a falling market. In Washington, President Herbert Hoover had said that the fundamental business of the country was on a sound and prosperous basis. Together, those gestures were meant to draw a line under Black Thursday, to suggest that the worst of the panic had been met by men and institutions strong enough to contain it. But confidence is not the same as a statement, and it is not the same as a purchase. Confidence has to be believed by the people expected to act on it. By that weekend, investors, brokers, bankers, and ordinary observers had seen enough to know that the market could move faster than reassurance. They had seen record trading volume overwhelm the normal rhythm of the New York Stock Exchange. They had seen the ticker fall behind. They had seen crowds gather outside the exchange in the financial district, not because they understood every mechanism at work, but because they understood that something important was slipping out of order. The bankers' intervention on Black Thursday had mattered because it was public. It was meant to be seen. Federal Reserve history identifies Charles E. Mitchell of National City Bank as part of the coalition of bankers involved in the effort to restore confidence. Their method was not hidden. The point was to demonstrate that major financial houses were willing to step into the market when others were trying to get out. If fear could be contagious, then perhaps visible strength could be contagious too. For a moment, that idea appeared plausible. The worst panic of Thursday had been checked. The spectacle of organized buying had shown that Wall Street's largest institutions were not simply watching prices collapse. They were acting. They were telling the market that good securities still had value, that panic selling had outrun reason, that powerful hands could still impose order. Hoover's statement the next day served a similar purpose, though in a different language. He did not buy shares from the White House. He offered interpretation. He told the country that the underlying business situation remained sound. He tried to separate the drama of the stock market from the wider condition of American enterprise. The market might have been shaken, but the nation, in his telling, still rested on firmer ground. Yet the same statement carried a tension that could not be easily dismissed. Hoover also acknowledged that building and construction had been affected by high interest rates induced by stock speculation. That admission mattered because it connected Wall Street's fever to ordinary economic activity. It suggested that speculation had not been sealed off from the rest of the country. Credit had been pulled toward the market. Interest rates had been pushed upward. Construction, one of the visible measures of business confidence and investment, had felt the strain. So the weekend opened with a contradiction. Officials and bankers were asking the public to trust that the system remained fundamentally sound. At the same time, the events of the previous days had revealed how fragile that trust could be. The contradiction was not only psychological. It was built into the machinery of the late 1920s boom. During the decade, billions of dollars had been drawn from banks into Wall Street to finance brokers' loans carrying margin accounts. Britannica reports that by midsummer 1929, roughly 300 million shares were being carried on margin. That meant many investors were not simply holding stocks they had bought outright. They were holding positions supported by borrowed money. In rising markets, margin could make optimism feel rational. A buyer could control more shares than cash alone would allow. Rising prices increased paper wealth and encouraged more confidence. But when prices fell, the same structure worked in reverse. Falling values threatened the collateral behind loans. Investors who could not meet demands for more money might be forced to sell. Forced selling could push prices down further, which could create still more pressure. This was why the weekend calm could not be measured only by whether officials sounded confident. Beneath the public language of reassurance, there remained a private question for countless accounts. What would happen if prices opened lower again? That question gave the pause its uneasiness. The market had not simply suffered a bad day. It had revealed a mechanism of fear. On Black Thursday, volume had surged to 12,894,650 shares on the New York Stock Exchange, far above the previous record of 8,246,742 shares set on March 26 of that same year. Numbers like that were not merely statistics. They were evidence of pressure. They showed how many decisions were being compressed into the same hours, how many people were trying to sell, cover, protect, escape, or bargain at once. When trading volume became so heavy that the ticker could not keep pace, the market's basic promise was weakened. Investors needed timely prices in order to judge what they owned. Brokers needed information to guide orders. Spectators needed quotations to turn rumor into fact. When that flow lagged, uncertainty filled the gap. A delayed price was not just late information.
In a panic, it could feel like darkness. The weekend could slow that process, but it could not resolve it. Newspapers, offices, homes, clubs, hotel lobbies, and brokerage rooms could all carry the same question forward. Had Thursday been the end of the panic or only the first clear view of it? For Wall Street's leaders, this was a dangerous kind of waiting. The bankers' purchases had been designed to steady the market by showing confidence. But if prices fell again, the earlier intervention might be reinterpreted. What had looked like strength could begin to look like a temporary barricade. What had looked like leadership could begin to look like delay. Hoover faced a similar risk. His statement had tried to separate fundamental business from stock speculation. But public confidence does not always respect that boundary. For many Americans watching events from outside the exchange, the stock market was the most visible symbol of prosperity. It had become a stage on which the claims of the 1920s were performed: rising values, easy optimism, expanding opportunity, and the belief that modern finance could support continued growth. When that stage shook, it raised questions larger than the price of any one share. Still, it is important to keep the moment precise. The severe banking panics most associated with the Great Depression had not yet begun. Federal Reserve history identifies the first major banking panic period as beginning later, from November 1930 to August 1931. During this weekend in October 1929, the immediate crisis was centered on Wall Street, on securities prices, margin accounts, brokers' loans, and confidence in the market. The fear had not yet fully moved into the nation's banking system in the form it would later take. But the emotional pattern was already visible. People were learning that confidence could disappear quickly. They were learning that public assurances might steady a moment without settling the underlying doubt. They were learning that institutions could act powerfully and still not command belief. That lesson was part of what made the pause after Black Thursday so consequential. If the market had stabilized permanently after the bankers' intervention and Hoover's statement, Black Thursday might have been remembered as a frightening break that was contained. It would still have mattered, but its meaning would have been different. It would have shown that panic could erupt and that organized leadership could stop it. Instead, the weekend left the central question unanswered. Prices had fallen. Intervention had come. The president had spoken. But the structure that had produced the fear remained in place. Margin accounts still depended on values that could fall. Brokers' loans still connected bank credit to market speculation. Investors still had to decide whether to hold, sell, or protect themselves when trading resumed. And everyone who had watched the ticker fall behind knew that the market's information machinery could be overwhelmed if fear returned in force. This is where the quiet of the weekend becomes historically important. It was not empty time between dramatic days. It was the interval in which reassurance was tested before the test had even begun. The country had been asked to believe that the crisis was manageable. Wall Street had been asked to believe that the strongest firms could defend confidence. Investors had been asked to believe that the worst selling had passed. But belief under pressure is not secured by one statement or one rescue operation. It has to survive the next wave of orders. When markets opened again, the question left hanging from Friday would no longer be theoretical. The banker's performance of confidence, Hoover's language of sound fundamentals, and the public's uneasy hope would all meet the same measure: prices. And on Monday, October 28, 1929, that measure would turn sharply against them. The question left hanging over the weekend was answered not by speeches and not by carefully staged confidence, but by the tape of prices itself. On Monday, October 28, 1929, the market opened into a different kind of test. The first shock had come on Black Thursday, when panic had become visible in the crowds around the New York Stock Exchange and in the flood of orders that overwhelmed the ordinary rhythm of trading. But Monday showed something more troubling. It showed that the panic had not been contained. The Dow Jones Industrial Average fell nearly 13% that day. That figure matters not only because it was large. It matters because of where it fell in the sequence of events. Black Monday came after the bankers had stepped in. It came after the public purchases meant to show that major banks and investment companies were still willing to support the market.
It came after Charles E. Mitchell of National City Bank and other powerful financial figures had helped create the impression that Wall Street's own leaders could draw a line beneath the decline. It came after President Herbert Hoover had spoken from Washington, saying that the fundamental business of the country was on a sound and prosperous basis. In other words, Monday was not the first moment of fear. It was the failure of reassurance. That made it especially damaging. A first panic can be interpreted as a rupture, a temporary break in judgment, a day when emotion overtakes calculation. A second panic, after visible efforts to restore order, carries a different meaning. It suggests that the forces driving the fall are stronger than the institutions trying to stop it. It suggests that confidence has not merely been shaken, but weakened at its base. Wall Street had spent the days after Black Thursday trying to make the crisis look manageable. The bankers' purchases had offered a public display of strength. Hoover's statement had placed the authority of the presidency behind the idea that the larger economy remained fundamentally sound. The weekend had given investors time to absorb those assurances. But time can work in more than one direction. It can calm. It can also allow fear to settle, spread, and become more organized. By Monday morning, investors were no longer responding only to the shock of Thursday. They were responding to the possibility that Thursday had been a warning, not an ending. This was the deeper significance of Black Monday. The market was no longer experiencing a single day of disorder. It was entering a sequence. The collapse was beginning to acquire momentum, and momentum is dangerous in a market built on confidence, credit, and expectations. Prices fall because sellers accept lower bids. But in a panic, prices can also fall because people begin to fear what other people will do next. The decision to sell becomes less about what a stock might be worth in ordinary times, and more about whether waiting another hour, another day, or another opening bell might mean being trapped at a worse price. That psychology was especially severe in a market shaped by margin accounts. During the late 1920s, billions of dollars had been drawn from banks into Wall Street to finance brokers' loans carrying those accounts. Britannica reports that in midsummer 1929, roughly 300 million shares of stock were being carried on margin. This meant that many investors did not own their stocks outright in the simple sense. They had bought with borrowed money, using the stocks themselves as collateral. When prices rose, that arrangement could magnify gains. When prices fell, it could magnify fear. A falling market threatened not only paper wealth, but the credit arrangements underneath that wealth. If collateral lost value, investors could be pressed to provide cash or face the sale of their securities. Selling could then push prices lower, which could create more pressure on other leveraged holders. The mechanism did not require every investor to panic at once. It required enough falling prices to make caution look dangerous. Black Monday therefore exposed the hidden machinery beneath the visible drama. The crowds, the exchange, the headlines, and the numbers were the public face of the crisis. Beneath them was a structure of borrowing and expectation that made falling prices self-reinforcing. Once confidence weakened, the market did not simply wait for calm judgment to return. It demanded cash. It demanded collateral. It demanded decisions under pressure. That pressure also changed the meaning of official language. Hoover's statement on Friday had not been empty. It reflected a belief, held by many public officials and business leaders, that the country's basic business conditions remained strong enough to withstand the shock of a market panic. But Black Monday revealed the limits of that kind of reassurance. The president could speak about fundamentals. The market was speaking about trust, and trust had become unstable. For those watching from outside the exchange, the distinction between the stock market and the broader economy may have been difficult to hold. The National Bureau of Economic Research would later date the business cycle peak before the Great Depression to August 1929, placing the beginning of the contraction before the most dramatic days of the crash. But to the public in late October, the visible crisis was Wall Street. The New York Stock Exchange in Lower Manhattan became the place where national anxiety could be seen. If prices collapsed there, many people could feel that something larger was collapsing, even if the full economic consequences had not yet unfolded. That is why Black Monday belongs at the center of this first week. It transformed the crash from an alarming event into an unfolding crisis of confidence. Black Thursday had shown that fear could overwhelm the market's machinery. Monday showed that intervention and reassurance had not restored durable belief. There was also an emotional difference between surprise and disillusionment. On Thursday, the scale of selling had stunned the market. By Monday, investors had already been told that the strongest financial interests were alert, that organized support had appeared, and that national business remained sound. When prices fell again, and fell so sharply, the loss was not just measured in market value. It was measured in the credibility of the rescue itself. If the bankers could not steady the market, who could? If presidential reassurance could not quiet fear, what words would? If a weekend pause did not allow confidence to recover, what would happen when the next day brought another wave of selling? These questions did not need to be written down to matter. They were embedded in the behavior of the market. Each sale, each lower price, each failed attempt to find a stable floor turned private doubt into public evidence. The market was not simply declining, it was demonstrating that the assurances of the previous days had not been enough. Still, it is important to keep the claim precise. Black Monday did not, by itself, create the Great Depression. The Depression was a longer contraction, one that would deepen over years and eventually include severe banking panics that did not begin during this first week. The first major banking panic period identified by Federal Reserve history would come later, from November 1930 to August 1931. The immediate crisis of late October 1929 was centered first in the stock market. But stock markets can change the mood of a country. They can turn optimism into caution and caution into fear. They can reveal how much prosperity had depended on rising prices, borrowed money, and the belief that tomorrow would look like yesterday, only better. On Black Monday, that belief broke again. The word again is essential. The market had already been frightened. It had already seen panic. It had already received rescue. Monday showed that the first fracture had not been repaired. It had widened. The nearly 13% fall in the Dow Jones Industrial Average made that clear in a way no official statement could easily explain away. The decline was not a rumor. It was not merely a crowd outside the exchange. It was a number attached to the most visible measure of industrial stock values in the country. It told investors that the attempted restoration of confidence had failed its first major test. And once that happened, the calendar itself became ominous. Monday was no longer a return to normal trading after an uneasy weekend. It became the day that proved the crisis had carried forward. The first shock had not exhausted the panic. The market had more falling still to do. By the close of October 28, 1929, Wall Street had moved into a more dangerous historical space. The crash was no longer remembered as a single break on Black Thursday. It was becoming a chain of days, each one testing whether confidence could survive the next opening bell. Monday had answered with a sharp no, and there was still another trading day ahead. After Black Monday, that fact mattered in a different way. The market had not merely fallen once and frightened people. It had fallen again after a weekend of reassurance, after the bankers' public intervention, after President Herbert Hoover had said that the fundamental business of the country was on a sound and prosperous basis. Monday had taken those assurances and tested them against prices. Prices had answered with a collapse. So Tuesday, October 29, 1929, opened under the weight of more than ordinary uncertainty. It opened after the market had already shown that panic could return. It opened after confidence had been publicly defended and then visibly broken. And by the time that day ended, Black Tuesday would become the name most firmly attached to the crash in American memory. The Dow Jones Industrial Average fell nearly 12% on Black Tuesday. That number is smaller than the nearly 13% fall of the day before, but history does not always remember events in exact mathematical order. Black Tuesday became historic because it confirmed the scale of the rupture. It made the crash feel less like a severe market break and more like a public event that would not pass quietly. By then, the panic had a sequence. Black Thursday had revealed it. The weekend had failed to settle it. Black Monday had deepened it. Black Tuesday fixed it in memory. The New York Stock Exchange in Lower Manhattan remained the central stage. The crowds, the rumors, the delay between events and reliable information, the pressure of selling orders, the sense that the machinery of the market could be overwhelmed by fear, all of that had already become part of the crisis. But Tuesday gave the week its most enduring symbol. In later memory, the phrase Black Tuesday would often stand for the crash as a whole, even though the collapse had unfolded across several days, and even though the economic contraction had begun before the panic week itself. That distinction matters. The Great Depression was not created in a single trading session. The National Bureau of Economic Research dates the United States business cycle peak before the Depression to August 1929 and the trough to March 1933. By that measure, the contraction lasted 43 months. The late October crash was therefore not the entire depression. It was not the whole explanation for the factory closures, the falling incomes, the banking crises, and the long unemployment that would follow. But it was a major turning point in public confidence. That is the quieter but more precise way to understand Black Tuesday. It did not by itself produce every later disaster. It did not instantly turn a stock market panic into a nationwide banking panic. The severe banking panics most closely associated with the Depression would come later. But Black Tuesday marked the point when the first week of Wall Street panic became impossible to treat as temporary noise. The fall had become historic because confidence had failed in public, repeatedly, in the most visible financial district in the country. For investors who had bought stocks with borrowed money, falling prices carried an especially hard logic. The late 1920s boom had been built in part on brokers' loans and margin accounts. Billions of dollars had been drawn from banks into Wall Street to finance that speculation. Britannica reports that in midsummer 1929, roughly 300 million shares of stock were being carried on margin. That meant the collapse was not just a matter of people watching paper values decline. It was also a matter of leverage tightening around them. When prices fell, the value of collateral fell with them. Investors who had purchased stock on margin could be pressed to provide more cash or see their holdings sold. In a falling market, forced selling could feed the fall itself. A decline could become not only a reflection of fear, but a mechanism for producing more fear. Black Tuesday belonged to that machinery. It showed how a loss of confidence could move through credit arrangements, brokerage accounts, and market orders with a force that no public reassurance could easily stop. This is why the crash became so powerful as a symbol. It made abstract weakness visible. Earlier in the year, there had already been signs of strain. President Hoover himself, in his October 25 statement, had acknowledged that building and construction had been affected by high interest rates induced by stock speculation. That admission mattered because it connected Wall Street's speculative demand for money to conditions beyond the exchange. Even while Hoover reassured the country about sound fundamentals, the language of his own statement pointed to pressure in the real economy. Black Tuesday made those contradictions harder to contain. If the nation's business foundations were sound, why was the most watched market in the country falling with such violence? If the bankers could restore confidence, why had the market broken again after their intervention? If the crash was only a temporary panic, why did each new trading day seem to reopen the wound? These were not technical questions only. They were questions of trust. Trust in prices. Trust in institutions. Trust in official reassurance. Trust in the idea that prosperity had a stable base beneath it. The danger of a market crash is not only that prices decline. Markets can fall without becoming national turning points. The deeper danger comes when falling prices begin to change what people believe is possible. A stock certificate that had represented future wealth could suddenly represent debt, exposure, or a mistake that had to be liquidated. A margin account that had seemed like a path into prosperity could become a demand for cash. A public statement meant to calm fears could begin to sound out of step with lived experience. Black Tuesday did not settle the crisis. It enlarged it. By mid-November 1929, the Dow had lost almost half of its value from before the late October collapse. That later fact is important because it reminds us that even Black Tuesday was not the final bottom. The market continued to search for a floor after the famous week had passed. In the summer of 1932, the Dow would fall to 41.22, 89% below its peak. It would not return to its pre-crash height until November 1954. Those longer measures can make Black Tuesday look like a beginning rather than an ending. And in many ways, that is what it was. It was the moment when a crisis of speculation became a crisis of memory, when the events of late October became fixed as a before and after in American economic life. But the later figures also protect us from exaggeration. The crash was catastrophic for confidence and wealth, but the depression deepened over years through contraction, credit weakness, bank failures, and policy choices. That is why a careful history has to hold two truths together. First, Black Tuesday deserves its place in memory. A nearly 12% fall in the Dow Jones Industrial Average, coming immediately after Black Monday's nearly 13% decline, was not an ordinary market fluctuation. It was the climax of a visible panic that had overwhelmed the old assumption that prosperity could be indefinitely extended through confidence and credit. Second, Black Tuesday was not the whole depression compressed into one day. The most severe banking panics came later. The collapse in money supply and bank lending between 1929 and 1932 came over time. The long path to March 1933 was not already complete on the floor of the New York Stock Exchange. But by the close of Tuesday, October 29, 1929, something essential had changed. The idea that the panic could be contained by a banker's pool, by optimistic statements, or by the mere passage of a weekend had lost much of its force. The market had shown that confidence, once broken, could not simply be commanded back into place. And that raised a harder question. If private bankers could not restore confidence, and if presidential reassurance could not stop the fall, what responsibility belonged to the institutions designed to manage credit itself? Behind the visible drama of Wall Street stood the younger machinery of central banking. The Federal Reserve System had been watching speculation, interest rates, and credit conditions before the crash, but its leaders were not of one mind. In Washington and at the Federal Reserve Bank of New York, officials had disagreed over how to respond to the boom and the danger it carried. After Black Tuesday, those disagreements would matter even more because the panic had exposed not only broken confidence in the market, but uncertainty inside the institutions that might have answered it. The uncertainty inside the institutions mattered because the crash was not only a collapse of prices, it was also a crisis in credit. Behind every crowded sidewalk outside the New York Stock Exchange, behind every delayed ticker report, behind every forced sale, there stood a question about money. Who would lend it, at what rate, for what purpose, and with what risk? That question led directly to the Federal Reserve. By 1929, the Federal Reserve System was still a relatively young part of American financial life. It had been created to give the country a more organized way to manage credit and banking stress, but it was not a single mind speaking with one voice. It was a system of institutions with a Federal Reserve Board in Washington, D.C., and regional Federal Reserve banks, including the Federal Reserve Bank of New York, whose position placed it closest to Wall Street. That geography mattered. Washington watched the national economy from the capital. New York watched the market from beside the center of speculation. The New York Stock Exchange, the banks that financed brokers' loans, and the movement of money into Wall Street were not abstractions there. They were daily conditions. The Federal Reserve Bank of New York saw the pressure building near the machinery that was producing it. And in 1929, leaders inside the Federal Reserve disagreed over what to do. The disagreement centered on speculation, credit, and the proper use of interest rates. At the Federal Reserve Bank of New York, Governor George Harrison favored raising the discount lending rate. The discount rate was the rate at which Federal Reserve banks lent to member banks. Raising it could make borrowing more expensive. In theory, that could restrain the flow of credit that was helping to feed speculation. It was a way of saying that money should not remain too easy when too much of it was being pulled toward the stock market. But the Federal Reserve Board in Washington did not simply accept New York's view. In 1929, the board denied several New York requests to raise the discount lending rate. This was not a small administrative quarrel. It revealed a deeper uncertainty about what kind of danger speculation represented and what kind of response a central bank should make. If the problem was too much credit flowing into Wall Street, then higher rates might look like discipline. If the problem was that higher rates could injure ordinary business, construction, and borrowing outside the stock market, then tightening credit could appear dangerous in another direction. The country had already seen this tension in President Herbert Hoover's statement on October 25, 1929. Hoover had said that the fundamental business of the country was on a sound and prosperous basis, but he also acknowledged that building and construction had been affected by high interest rates induced by stock speculation. That sentence contained the dilemma in miniature. Speculation was not isolated inside the stock exchange. It was influencing the cost of credit. It was pulling money, attention, and pressure into Wall Street, while other parts of the economy felt the strain. For Federal Reserve officials, the question was not simply whether speculation was real. The question was how to restrain it without damaging the broader economy. A higher discount lending rate might discourage speculative borrowing, but it could also make credit more expensive for banks and borrowers whose needs had little to do with stocks. A refusal to raise the rate might avoid tightening too broadly, but it could also leave the speculative machine with more room to keep running. That was the divided response. The Federal Reserve Bank of New York, closer to the market's fever, pushed for a stronger rate response. The Federal Reserve Board in Washington, holding authority over those requests, resisted several of them. The result was not decisive unity, but institutional friction at a moment when confidence was becoming more fragile. This matters because the crash is sometimes remembered as if the authorities were simply absent or as if they saw nothing. The record is more complicated. Federal Reserve leaders did see speculation as a problem. They did debate how to answer it. But seeing danger is not the same as agreeing on the cure. In 1929, the central banking system faced a problem for which its own leaders did not share a settled doctrine. And the timing made that uncertainty more consequential. Before Black Thursday, before Black Monday, before Black Tuesday, the problem could still be framed as prevention. How should the Federal Reserve restrain speculative excess before it became disaster? After the crash, the problem changed. Now officials had to think not only about restraining speculation, but also about the damage left behind when confidence broke. That shift was severe. During the boom, the fear was that too much credit was helping investors buy too much stock at too high a price. After the late October collapse, the fear became that falling prices and shaken confidence could spread outward. A policy meant to restrain excess before the crash might not be the same policy needed after panic had already arrived. But institutions do not always change direction cleanly in the middle of a crisis, especially when their leaders have already been divided. The Federal Reserve's divided response also shows why the first week of the crash became more than a spectacle of Wall Street emotion. The panic exposed a weakness in the country's financial command structure. The bankers' buying operation on Black Thursday had shown the limits of private rescue. Hoover's reassurance had shown the limits of public language. The disagreement between Washington and New York showed that even the institutions responsible for credit were uncertain about how forcefully to act and in what direction. This was not yet the nationwide banking panic that would come later. The severe banking panics associated with the Depression did not begin during the crash's first week. Federal Reserve history identifies the first major banking panic period as running from November 1930 to August 1931. That distinction is essential. In late October 1929, the crisis was still centered most visibly on the stock market. The crowds were outside the exchange. The dramatic numbers were trading volume and falling stock averages. The public image was Wall Street in distress. But the Federal Reserve disagreement reminds us that a stock market panic was already tied to the deeper system of credit. The market did not rise on optimism alone, and it did not fall on fear alone. It had been supported by mechanisms that connected banks, brokers, and investors. Billions of dollars had been drawn from banks into Wall Street to finance brokers' loans carrying margin accounts. Those connections made the crash more dangerous than a simple change in stock prices. They meant that falling confidence could travel through obligations, collateral, interest rates, and lending decisions. That is why the argument over the discount lending rate matters. It was a debate over the cost and direction of credit. It was also a debate over responsibility. Should the Federal Reserve act directly against speculation by making money more expensive? Should it avoid measures that might hurt the broader economy? Should New York's proximity to Wall Street give its judgment special weight? Or should Washington's broader view prevail? There was no easy answer inside the moment. If officials acted too sharply, they risked tightening credit when parts of the economy were already vulnerable. If they acted too gently, they risked allowing speculative pressure to continue until the break became worse. In 1929, the Federal Reserve System did not resolve that tension in a way that produced a clear, unified public response.
For listeners looking back,
The importance is not that one office was simply alert and another simply blind.
the importance is that the crash unfolded inside disagreement.
The central bank's structure contained different vantage points, different fears, and different judgments about how markets and credit should be managed. New York, led by George Harrison, wanted the discount lending rate raised.
The Federal Reserve Board in Washington
Denied several New York requests.
That contrast helps explain why the
Response to speculation before the crash and to panic around the crash did not feel like a single steady hand.
by the end of Black Tuesday,
The problem had become visible in a new way.
the issue was no longer confined to whether stock prices had been too high.
It was whether the credit system that had helped carry those prices could absorb the reversal.
Margin accounts,
Brokers' loans, high interest rates, and the movement of bank money into Wall Street had formed a hidden machinery beneath the public drama.
the Federal Reserve's divided response pointed toward that machinery,
Because the fight over rates was really a fight over how credit itself had been feeding the boom.
to understand why panic could accelerate so quickly.
We have to move below the exchange floor and below the public statements.
We have to look at the arrangements that
Turned falling prices into forced decisions, and forced decisions into more selling.
the crash was visible on the ticker, but its pressure was built in credit.
Leverage and trust.
The crash was visible on the ticker, but the force that made it so dangerous,
Was not confined to the printed movement of prices.
it lived in the credit arrangements
Beneath the market, in agreements that had seemed ordinary during the boom and suddenly became urgent when confidence broke. To understand the first week of panic, we have to slow down inside that machinery.
A stock market can fall because
People decide that shares are worth less than they were yesterday.
But in late October
1929, falling prices did more than change opinions.
they changed obligations.
They changed the amount of money investors had to produce. They changed the value of collateral.
They changed the willingness of lenders to wait.
And when those changes happened at the same time, fear could become mechanical.
One of the key mechanisms
Was the margin account. Buying on margin allowed an investor to purchase stock without paying the full price in cash. The investor put up a portion of the money, and the rest was financed through credit.
in a rising market.
This could feel like a tool of opportunity. A buyer could control more shares than his cash alone would allow.
If prices rose,
The gains were magnified.
the same dollar could seem to reach farther. The boom could appear to confirm the wisdom of borrowing. But leverage works in both directions. When stock prices fell,
Losses were magnified too.
and more importantly,
Falling prices weakened the collateral that supported the loan.
the stock itself was part of the security
Behind the borrowing,
If the stock declined enough,
the investor could be required to provide more cash or more collateral. If that cash was not available, the stock could be sold.
that is where a decline in prices
Could become forced selling.
An investor might not want to sell. He might believe the market would recover,
He might think the panic was temporary.
but a margin account did not wait for confidence to return.
If the collateral was no longer sufficient, the account demanded action. Cash had to be found, or shares had to be liquidated.
This is why the crash was not simply a collective change of mood. It was a credit event.
It pushed people from preference into necessity. The market did not only ask, "What do you think these shares are worth?"
It asked,
"Can you meet your obligation now?"
behind the margin account
Stood the broker's loan. Brokers needed funds to finance the credit they extended to customers.
during the late 1920s.
Billions of dollars were drawn from banks into Wall Street to finance those brokers' loans carrying margin accounts.
This movement of money mattered.
Because it connected the speculative market to the wider banking system.
The boom was not only a matter of
Individual investors taking risks with their own savings.
it was also a matter of bank credit.
Being pulled toward the stock exchange.
The scale was enormous.
Britannica reports that in midsummer 1929, roughly 300 million shares of stock were being carried on margin. That figure helps explain why the panic could move with such speed. It was not just that many people owned stocks. It was that many shares were tied to borrowed money. Under those conditions, price declines could call forth more selling, and that selling could produce still lower prices, which could then trigger still more pressure on margin accounts.
A market built this way
Could look strong while prices were rising.
borrowing made demand larger. Rising prices made collateral appear sound. Paper gains seemed to justify more confidence.
Each part reinforced the other. The investor believed the market was healthy because prices were rising. The lender felt protected because the collateral was valuable. The broker could extend credit because funds were available. Banks could be drawn toward Wall Street because the demand for loans was strong. But when prices turned downward, the same structure reversed. The investor's equity shrank. The broker had to protect the loan. The lender became more cautious. The value of collateral became uncertain. What had looked like abundance could become a scramble for cash. High interest rates were part of the same story. President Herbert Hoover's October 25 statement tried to reassure the country that the fundamental business of the United States was on a sound and prosperous basis. But even in that statement, he acknowledged a pressure point. Building and construction, he said, had been affected by high interest rates induced by stock speculation. That sentence matters because it shows that the speculative boom was not sealed off from the rest of the economy. Money drawn into Wall Street had consequences beyond the exchange. When credit was attracted by stock speculation, other borrowers felt the pressure. Building and construction could be affected because the cost of money had risen. In other words, the market boom did not merely create paper wealth for investors. It also helped shape the terms on which businesses and projects could obtain credit. This was part of the anxiety inside the Federal Reserve System. Leaders disagreed in 1929 about how to respond to speculation and the crash. At the Federal Reserve Bank of New York, Governor George Harrison favored raising the discount lending rate. The Federal Reserve Board in Washington denied several New York requests. The disagreement was not an abstract quarrel over policy language. It reflected a deeper problem. How should a young central banking system respond when credit seemed to be feeding speculative excess? Raise rates and the speculative borrowing might be restrained. But higher rates could also add pressure elsewhere. Keep rates lower and the flow of credit into speculation might continue. But restricting credit after a panic had begun could also risk making fear worse. The policy dilemma was difficult because the speculative machinery was already connected to broader confidence. By the first week of open panic, these connections were no longer theoretical. Black Thursday had shown that selling could overwhelm the exchange's capacity to process the rush. Black Monday and Black Tuesday had shown that reassurance and public buying could not simply command confidence back into existence. But underneath those visible events, margin and credit were turning uncertainty into action. If investors lost confidence, they might sell. If lenders lost confidence, they might demand protection. If collateral lost value, accounts could be closed out. Each decision could be rational on its own. Together, they could intensify the fall. Trust was the fragile element holding the system together. Investors trusted that rising prices would continue, or at least that declines would be manageable. Brokers trusted that customers could meet their obligations. Banks trusted that loans connected to Wall Street were adequately secured. Public officials trusted, or hoped, that the country's basic business conditions could be separated from the market panic. But the crash tested all of those trusts at once. This is why confidence mattered so much. It was not merely a mood or a slogan. It was a working part of the financial structure. Credit depends on belief about the future. A loan is made because the lender expects repayment. Collateral is accepted because someone believes it can be valued and sold. A margin account functions because prices are stable enough and customers are solvent enough for the arrangement to hold. When those beliefs weaken, the same contracts remain on paper, but their meaning changes. They become demands, deadlines, and forced sales. The first week of the crash revealed that Wall Street's prosperity had rested partly on borrowed confidence. The phrase is not only metaphorical. Borrowing had allowed speculation to expand. Confidence had allowed borrowing to feel safe. Rising prices had hidden the vulnerability. Once prices fell sharply enough, the hidden machinery became visible through its effects: frantic selling, pressure for cash, public fear, and official uncertainty. Still, it is important to keep the sequence precise. The panic of late October 1929 did not immediately become the full banking crisis most closely associated with the Great Depression. The severe banking panics came later. In the first week, the center of visible fear remained Wall Street, the New York Stock Exchange, and the credit structure that had helped carry speculative stocks. But the first week showed how fear could travel. It showed how distrust of prices could become distrust of loans, and how distrust of loans could raise questions about the institutions behind them.
The crash did not yet produce the later wave of bank runs. It did something earlier and more specific.
It broke the assumption that the machinery of credit would keep working smoothly because it had worked smoothly during the boom. That break in assumption was one of the week's lasting consequences.
The falling market exposed leverage.
Leverage exposed dependence on borrowed funds.
Borrowed funds exposed the ties between Wall Street and banks.
And those ties exposed a larger question that would haunt the years ahead. When confidence fails in one part of the financial system, how far can the failure spread? In late October, the answer was not yet fully known.
The crowds outside the exchange were not yet the same as
Depositors lining up at banks across the country.
A collapsing stock price was not yet the same as a closed bank door.
But the first week had revealed the path by which one kind of fear could prepare the ground for another.
The panic had begun with shares,
Margin accounts, brokers' loans, and high interest rates.
It had not yet become the Depression's great banking panic,
But it had shown how deeply credit and trust were intertwined, and how quickly a market crisis could make the foundations beneath ordinary confidence feel less secure.
That was the uneasy boundary exposed by the first week.
Wall Street had suffered a public collapse in confidence, and credit had carried the shock through brokers' loans, margin accounts, and forced selling.
But the crisis had not yet taken its most feared later form.
In late October 1929, the crowds outside the New York Stock Exchange were watching a market break.
They were not yet witnessing the
Nationwide banking panics that would come to define the Depression in millions of private lives. This distinction matters because memory often compresses the Great Depression into a single dramatic sequence. The market crashes, banks fail, breadlines appear, and the nation descends.
As a story, that sequence is powerful. As history, it is too simple.
The first week of open panic on Wall Street was not the same thing as the later banking crisis. It was a beginning, a warning, and a rupture in confidence. But it was not yet the full collapse of trust in the ordinary banking system.
Federal Reserve history
Identifies the first major banking panic period of the Depression as running from November 1930 to August 1931. That is more than a year after Black Thursday, Black Monday, and Black Tuesday.
The gap is important.
It tells us that the Depression did not move instantly from falling stock prices to nationwide bank runs.
Fear had to travel. It had to change shape. It had to move from the exchange floor
And the brokerage account into the places where households, farms, shops, and local businesses kept their deposits.
a stock market panic.
And a banking panic are related, but they are not identical.
In a stock market panic,
Investors rush to sell. Prices fall because many people are trying to escape the same asset at the same time. A person who no longer trusts a stock tries to turn it into cash. In a banking panic, the fear is more direct.
a depositor who no longer trusts a bank
Tries to withdraw cash before others do. The question is no longer only, what is this security worth? It becomes, will my money still be there when I ask for it? That change in question is profound. During the crash's first week, the central drama was still concentrated around securities, credit, and the machinery of trading. The New York Stock Exchange in Lower Manhattan served as the public stage.
Ticker reports fell behind. Prices broke.
Bankers tried to steady confidence by buying large blocks of stock. President Herbert Hoover issued reassurance that the fundamental business of the country was on a sound and prosperous basis, even as he acknowledged that building and construction had been affected by high interest rates induced by stock speculation. The visible problem was severe, but it was still being framed as a market crisis, a confidence crisis, a problem of speculation and credit.
A later banking panic would feel different.
It would not require a person to own stock. It would not be limited to investors who had bought on margin. It could reach someone whose life had no direct connection to Wall Street, someone whose savings sat in a local bank, someone whose employer depended on a line of credit, someone whose town relied on a chain of correspondent relationships that few depositors fully understood. That later phase would make the Depression deeper because it would threaten the everyday institutions through which money moved. The first week did not yet become that. It did, however, help create the conditions in which that later fear could be understood. The crash weakened confidence in judgment, in leadership, and in the promises made by financial institutions. The bankers' intervention on Black Thursday had shown that leading figures in finance believed confidence could be restored through visible action. But the renewed collapse on Black Monday and Black Tuesday showed that confidence could not simply be commanded. Once the public had seen the market fall through the efforts to steady it, reassurance itself became more fragile. That is why the dates matter. October 1929 marks the first week of open Wall Street panic. November 1930 to August 1931 marks, in Federal Reserve history's account, the first major period of banking panic. Between those moments lay a transformation in the crisis. The problem moved from the value of stocks to the reliability of institutions. It moved from the fear that paper wealth had vanished to the fear that deposits, credit, and banking relationships might not hold. The National Bureau of Economic Research dates the broader contraction from August 1929 to March 1933. That chronology also helps keep the story clear. The downturn had begun before Black Thursday. The crash occurred after the business cycle peak, and the worst banking panics came later still. The first week did not start every part of the Depression at once. Instead, it marked a turning point in public psychology. It revealed that confidence, once damaged, could spread instability through systems that depended on trust. The distinction is not meant to reduce the importance of the crash. Black Thursday, Black Monday, and Black Tuesday mattered precisely because they changed what Americans believed was possible. A market that had seemed to promise continuing expansion suddenly displayed disorder. Credit arrangements that had seemed routine became dangerous. The movement of billions of dollars from banks into Wall Street to finance brokers' loans no longer looked like a clever way to profit from rising prices. It looked like a channel through which risk could move. But if we make the crash carry too much of the later story, we lose sight of how the Depression deepened. The banking panics were not merely an echo of the first week. They had their own mechanisms, their own geography, and their own timing. They unfolded through banks, depositors, reserves, correspondent relationships, and regional networks. They were connected to the loss of confidence, but they were not the same event as the late October market collapse. This is one of the quiet lessons of the first week. A crisis can begin in one place before it is fully visible in another. In October, the most dramatic images were in Lower Manhattan. The crowds outside the exchange made fear visible. The record volume of trading made panic measurable. The fall of the Dow Jones Industrial Average on Black Monday and Black Tuesday made the collapse historic. But the later danger would not always gather in front of a single famous building. It would appear in bank lobbies, in local newspapers, in withdrawals, in closed doors, and in the sudden realization that trust in a bank could disappear as quickly as trust in a stock. The first week, therefore, stands as a beginning, not a completed disaster. It did not yet include the collapse of Caldwell and Company in Nashville, Tennessee. It did not yet include the Bank of Tennessee closing in November 1930. It did not yet include the Bank of United States ceasing operations in December 1930. Those events belonged to a later stage, when fear moved more directly into the banking system. But the crash made that later stage more imaginable. It showed how quickly confidence could break, how official reassurance could fail to settle nerves, and how financial mechanisms could connect private decisions to public panic. By the end of Black Tuesday, Americans had not yet experienced the Depression's first major banking panic period. But they had seen enough to know that the old assumptions were no longer safe. Prices could fall with terrifying speed. Credit could tighten under pressure. Leaders could disagree. Institutions could appear strong one day and uncertain the next. The market had not brought down the entire banking system in a single week. Yet it had damaged the belief that the system was orderly, predictable, and secure. That damaged belief would matter when the crisis moved beyond Wall Street. The United States banking system was not a single, simple structure. It was a wide and fragmented landscape of member banks, non-member banks, local institutions, and correspondent ties. Once fear began to travel through that landscape, it would find many routes. The first week had shown what panic looked like when it gathered around stocks. The next phase would show what happened when the same force approached the banks that held ordinary deposits. The path from Wall Street to the banking system was not a straight line. It did not run from Black Tuesday directly to locked bank doors across the country. For a time, the damage was more subtle. It moved through expectations, through balance sheets, through the memory of falling prices, and through the growing doubt that institutions could always meet the promises they had made. That distinction matters because the first week of the crash was visible in one place. The New York Stock Exchange in Lower Manhattan gave the panic a stage. Crowds could gather outside it. Newspapers could report the volume of trading. The ticker could fall behind. The Dow Jones Industrial Average could be watched as it dropped. But the banking system was different. It was not a single building, and it was not a single market. It was spread across cities, towns, and regions inside thousands of institutions that varied in size, membership, reach, and connection. By the fall of 1930, the United States had more than 8,000 Federal Reserve member commercial banks. Alongside them stood nearly 16,000 non-member commercial banks. Those figures are essential to understanding how fear could travel. The country did not have one compact banking system that could be understood at a glance. It had a fragmented landscape with institutions tied to local communities, regional financial centers, and larger networks of banking relationships. In the first week of the crash, fear had concentrated around stocks. A person who watched stock prices fall might worry about paper wealth, about loans secured by shares, about margin calls, or about the credit that had supported the speculative boom. But when fear reached banks, the psychology changed. A stockholder could sell a stock, even at a loss. A depositor who feared a bank could fail had a more immediate impulse: withdraw cash before others did. That made banking fear especially dangerous. It was not only a judgment about future value, it was a race over present access. A bank could be sound in one sense and still vulnerable if enough people suddenly demanded their deposits at the same time. Confidence was not decoration. It was part of the operating structure. The crash of late October 1929 did not by itself produce the severe banking panics later associated with the Depression. Federal Reserve history identifies November 1930 to August 1931 as the first major banking panic period. That means nearly a year separated the first week of open Wall Street panic from the later banking emergency. But the interval should not be mistaken for safety. It was a period in which confidence had been weakened, credit had been strained, and the public had already seen that reassuring words and prominent institutions could fail to stop a collapse once fear gathered force. The numbers from the fall of 1930 help explain why the banking crisis could not be contained simply by pointing to one central institution. More than 8,000 Federal Reserve member commercial banks were part of the Federal Reserve System. Nearly 16,000 non-member commercial banks were outside that membership. Together, they formed an enormous patchwork. Some banks served large cities. Others served smaller towns and rural communities. Some were connected more closely to the Federal Reserve structure. Others stood apart from it, while still participating in the broader banking world through their own relationships and obligations. In such a landscape, panic did not need to begin everywhere. It only had to begin somewhere credible enough to make people question what else might be weak. That was one of the lessons carried forward from Wall Street. The crash had shown how quickly a visible break in confidence could become a wider judgment. On Black Thursday, bankers had tried to restore trust through public purchases of stock. For a brief moment, that display suggested that powerful institutions could steady the market. Then came Black Monday and Black Tuesday, and the reassurance lost much of its force. The later banking crisis would carry that lesson into a different setting. When a bank appeared uncertain, depositors did not need to understand every detail of its assets. They did not need to know all of its loans, investments, or relationships. They only had to wonder whether waiting might leave them last in line. In a fragmented system, where thousands of banks served thousands of communities, rumor and example could matter as much as formal information. This is why the movement from Wall Street to banks was also a movement from public spectacle to local anxiety. The stock market crash could be imagined in Lower Manhattan, around the exchange, the trading floor, the ticker, and the crowds outside. A banking panic could appear in a neighborhood, at a town bank, at a regional institution, or through a correspondent relationship connecting one bank to another. It could feel less dramatic at first, but more intimate. It touched payrolls, household savings, business deposits, and the ordinary working trust that people placed in a bank's front door. The fragmentation of the banking system also meant that weakness could be transmitted through connections that were not always visible to depositors. Banks did not exist in isolation.
Some depended on relationships with other banks. Some held balances through correspondents. Some were tied into regional systems of confidence and credit. When one institution failed or came under suspicion, the question could quickly become whether other institutions were exposed, dependent, or merely similar enough to be distrusted. The first week of the crash had introduced Americans to a terrifying speed of financial change. Prices that had seemed elevated by optimism could fall with historic force. Credit arrangements that had seemed manageable could become urgent. A market that had appeared deep and powerful could be overwhelmed by selling. By the fall of 1930, the country was facing the possibility that a similar loss of confidence might spread through a far broader and more delicate structure. And unlike the stock exchange, the banking system held the daily money of ordinary life. Its fragility did not have to announce itself through a dramatic index number. It could appear through a closed window, a delayed payment, a line of worried depositors, or the news that a bank in another city had failed. Once that news carried through a system of more than 8,000 Federal Reserve member commercial banks and nearly 16,000 non-member commercial banks, the scale of the problem became clear. Fear had many doors through which it could enter. This is the bridge between late 1929 and the crisis that followed. The crash damaged public confidence, but the banking panics tested the institutions that depended on confidence every business day. Wall Street had shown how panic could gather around falling prices. The banking system would show how panic could gather around promises. The promise that deposits were available, that banks were connected safely, that credit relationships were reliable, and that money placed in an institution would still be there when needed. By November 1930, that test was no longer abstract. It would begin to take shape far from the famous crowds outside the New York Stock Exchange, in Nashville, Tennessee, around Caldwell and Company, the Bank of Tennessee, and a set of correspondent ties that could carry fear from one institution to another. The geography of the crisis was widening. The confidence broken on Wall Street was approaching the banking networks of the country. The geography of the crisis was widening, and that mattered. The first week of Wall Street panic had unfolded in the most visible financial district in the country, under the shadow of the New York Stock Exchange, with crowds gathering where falling prices could be watched almost as a public event. But the banking panic that followed in the Depression's next phase did not need a famous street corner. It could begin inside relationships most depositors never saw. The relationships between local banks, larger city banks, correspondent institutions, and the reserves that connected them. In November 1930, one of the critical centers of that widening fear was Nashville, Tennessee. There, Caldwell and Company stood at the center of a regional financial network. Federal Reserve history identifies Caldwell and Company as a financial holding company headquartered in Nashville, and its collapse helped trigger a correspondent banking cascade. The phrase can sound technical, almost distant, but its meaning was simple enough for depositors to feel immediately. One institution's weakness could raise questions about another. One closed door could make people wonder whether a different door would close next. The Bank of Tennessee in Nashville closed on November 7, 1930. That date belongs to the first major banking panic period identified by Federal Reserve history, from November 1930 to August 1931. It was not the first week of the stock market crash. It was later, after confidence had already been damaged, after business conditions had weakened, and after the public had seen that major financial assurances could fail. The fear now moved through banks, and bank fear had a different rhythm from stock market fear. A falling stock price could ruin wealth. A suspected bank failure could threaten access to cash. The difference was psychological, but it was also mechanical. Banks depended on confidence because they did not keep every depositor's money sitting unused in a vault. Deposits were part of a working credit system. Banks made loans. They held reserves. They maintained balances with other banks. They cleared checks. They trusted that daily flows of money would offset one another and that only a fraction of depositors would demand currency at the same time. When confidence held, the system could appear stable and ordinary. When confidence failed, the same structure could become a pathway for panic. Correspondent banking was one of those pathways. In a fragmented banking landscape, smaller banks often held deposits with larger banks in nearby cities or financial centers.
Those larger banks could act as correspondents, providing services, holding balances, helping clear checks, and linking local institutions to wider financial markets. This arrangement could make banking more efficient in normal times. It gave smaller banks access to services they could not easily provide alone. It allowed money to move through networks rather than remain isolated in each town. But correspondent relationships also meant that a local bank's strength was partly tied to confidence in other banks. If a bank's reserves were held with a correspondent, and that correspondent was weakened, closed, or suspected of weakness, then the local bank might suddenly appear less secure. Depositors did not need to understand every ledger entry. They only needed to believe that their bank's money might be entangled with a failing institution. In a panic, suspicion could travel faster than verified information. Federal Reserve history describes mechanisms that made this structure vulnerable, including reserve pyramids, floating checks, and fictitious reserves. Each term points to a way in which confidence and accounting could become dangerously intertwined. A reserve pyramid developed when banks counted balances held at other banks as part of their reserves, and those other banks, in turn, might hold balances with still larger institutions. The image is useful because it suggests layers. At the bottom were local banks serving communities and depositors. Above them were larger correspondent banks. Above those might be still larger city banks or reserve centers. In good times, this pyramid could seem like a rational structure. Funds were concentrated where they could be used, cleared, and transferred. But in a panic, the same pyramid could magnify stress. If many banks at the base wanted cash or usable reserves at once, the institutions above them could be strained. What had looked like strength through connection could become weakness through dependence. Floating checks added another layer of uncertainty. A check did not always become settled money instantly. There could be a delay between the moment a check was written, deposited, credited, and finally collected from the bank on which it was drawn. During that interval, funds might appear in one place before they had fully cleared from another. In normal conditions, this was part of the ordinary movement of payments. The system relied on time, routine, and trust. But when banks were under pressure, delays and unsettled items could make the true position of an institution harder to judge. A balance sheet could include claims that were not yet cash in hand. Fictitious reserves were still more troubling because the term suggests reserves that appeared to exist in accounting but did not provide the protection depositors assumed. If a bank treated certain balances or items as available reserves when they were not truly available in a crisis, then its apparent strength could be misleading. In calm conditions, the difference might remain hidden. In a run, when depositors wanted currency and other banks wanted settlement, that difference could become decisive. The collapse around Caldwell and Company showed how fear could move through these kinds of relationships. Caldwell was not simply a name on one building. It was connected to institutions and affiliates across places. After the Bank of Tennessee closed in Nashville on November 7, Caldwell-related failures followed in Knoxville, Tennessee, and Louisville, Kentucky on November 12 and November 17. The sequence mattered. It showed panic spreading, not as an abstract mood, but along institutional lines. Nashville, then Knoxville, then Louisville. Different cities, different depositors, but connected by the fear that relationships once treated as safe might transmit weakness. This was the contagion of fear in banking. It did not require every bank to be insolvent in the same way. It did not require every depositor to have precise knowledge. Panic often grew from uncertainty itself. If people could not tell which banks were exposed, which reserves were real, which correspondent balances were safe, or which checks would clear, then withdrawal could seem like the only prudent act. Each depositor might think privately, better to be early than late. But when many people reached that conclusion together, private caution became public danger. The regional setting also helps explain why the Depression's banking crisis cannot be understood only through New York. The crash's first week had made Wall Street the visible symbol of broken confidence, but the banking system was national, local, and fragmented. It included Federal Reserve member banks and many more non-member commercial banks. It crossed Federal Reserve districts, including the 6th Federal Reserve District headquartered in Atlanta and the 8th Federal Reserve District headquartered in St. Louis. Caldwell's troubles touched a region where banking relationships linked communities to larger financial networks. The panic did not need to originate in the nation's largest stock exchange to become serious. It needed only a credible sign that promises inside the banking system might not be kept. What made this especially damaging was that banks were not merely places where people stored money. They were part of everyday economic circulation. Businesses needed deposits, credit, and payment services. Households needed access to savings and cash. Farmers, merchants, workers, and local institutions all depended on the belief that bank balances were reliable. When that belief weakened, ordinary life became defensive. People held cash if they could. Banks became more cautious. Lending could tighten. The pressure that began as a question about one institution could become a question about the system's ability to support commerce. The Caldwell episode therefore belongs to the larger story of confidence after the crash. It did not erase the importance of Black Thursday, Black Monday, or Black Tuesday. Instead, it revealed what those days had helped prepare. The first week had shown that confidence could collapse suddenly in a public market. The banking panic showed that confidence could also collapse quietly through correspondent balances, reserve structures, unsettled checks, and rumors that moved from one town to another. On Wall Street, panic had been measured in falling prices and overwhelmed trading machinery. In the banking system, panic was measured in withdrawals, closures, and the fear that reserves might not be as solid as they appeared. By late 1930, the crisis of belief had crossed a threshold. It was no longer only about investors who had bought on margin or banks that had sent money into brokers' loans. It was about depositors asking whether their own institutions could withstand a rush for cash. Caldwell and Company, the Bank of Tennessee, Knoxville, and Louisville showed how regional finance could become a transmission line. The machinery was complicated, but the emotional force was plain. When people doubted the safety of a bank, they did not wait for a lecture on reserve pyramids. They tried to get their money. That was how broken confidence deepened. The stock market crash had been a turning point, but the banking panics gave the Depression a harsher and more intimate form. They brought the crisis from quotations and tickers into the institutions that held paychecks, savings, business accounts, and local credit. From there, the damage would widen further through more bank failures, a shrinking supply of money and lending, and eventually the search for repair, new authority, new guarantees, and new public efforts to convince Americans that a bank deposit could once again be trusted. From the banks of Tennessee, Knoxville, and Louisville, the story widened into something more national and more lasting. The problem was no longer only that stock prices had fallen, or that a regional financial network had failed under pressure. The deeper problem was that confidence itself had become damaged. Once people began to doubt whether promises could be kept, every institution that depended on trust became vulnerable. That was the long aftermath of the first week. The panic of late October 1929 had been dramatic because it was visible. Crowds could gather outside the New York Stock Exchange. Newspapers could report record trading volumes. The ticker could fall behind, and that delay itself could become a symbol of disorder. But the damage that followed was slower, less theatrical, and in many ways more destructive. It moved through banks, through credit, through the money supply, through the ordinary channels by which households saved and businesses borrowed. By the summer of 1932, the Dow Jones Industrial Average had fallen to 41.22. That number marked a collapse of about 89% from its peak. The scale is difficult to hold in mind because it was not just a chart moving downward. It was the destruction of paper wealth, the breaking of expectations, and the long confirmation of fears that had first been exposed in the crash. The market that had seemed so powerful in the late 1920s had not merely corrected. It had been transformed into evidence that the old assumptions had failed. And the recovery of that confidence was not quick. The Dow did not return to its pre-crash height until November 1954. By then, a generation had lived with the memory of what could happen when markets, banks, and public trust broke together. The first week of panic had lasted only a few trading days. Its shadow lasted for decades. The wider economy was already contracting before Black Thursday. The National Bureau of Economic Research dates the business cycle peak before the Great Depression to August 1929 and the trough to March 1933. That full contraction lasted 43 months. But the crash mattered because it changed the emotional and financial atmosphere in which that contraction unfolded. It did not create every failure by itself. It did something more specific and still very powerful. It made fear credible. Once fear became credible, the banking system became the central place where it could do the most damage. A stockholder who lost confidence could sell a share. A depositor who lost confidence tried to withdraw money. And if too many depositors reached that conclusion at the same time, even a bank with real assets could be forced into crisis. Banking depended on the belief that money left in an institution would be available when needed. When that belief weakened, the problem became immediate. The closing of the Bank of United States on December 11, 1930, showed how far the crisis had moved. Federal Reserve history describes it as the fourth largest bank in New York City. Its name made the event sound even larger than it was institutionally, as if a private bank's failure might imply something official or national. But even without that confusion, the failure mattered. It came after the regional shocks connected to Caldwell and Company, and it belonged to the first major banking panic period that Federal Reserve history identifies, from November 1, 1930 to August 1931. By then, the center of fear had shifted. In October 1929, anxiety had gathered around Wall Street prices. In late 1930, it gathered around bank deposits. That shift was one of the defining movements of the Depression. It made the crisis more intimate. It reached into savings accounts, business accounts, payrolls, and local lending relationships. It affected not only people who had speculated in stocks, but people who believed they had simply placed their money somewhere safe. The numbers behind the banking collapse reveal the scale of the damage. Between 1929 and 1932, the United States money supply and bank lending declined by more than 30%, according to the National Bureau of Economic Research's summary of research by Chris James Michener and Gary Richardson. That contraction mattered because money and credit were not abstract forces. They were the means by which businesses carried inventories, farmers financed operations, employers met payrolls, and families managed uncertainty. When banks failed, when deposits were frozen or lost, when lending contracted, the economy lost circulation. A shrinking money supply could deepen a downturn by making every burden harder to carry. Debts became heavier. Cash became more precious. Banks, trying to survive, could become more cautious. Borrowers, already frightened, could pull back. The crisis fed on itself, not only through panic in the streets, but through caution in offices, ledgers, and loan decisions. Broken confidence became a mechanism. This is why the repair of confidence eventually required more than speeches of reassurance. Earlier, President Herbert Hoover had insisted, on October 25, 1929, that the fundamental business of the country was on a sound and prosperous basis. That statement was meant to steady the public. But as the Depression deepened, reassurance alone could not restore trust in a system where depositors had seen banks close and credit shrink. Confidence had to be rebuilt through visible authority, new rules, and practical guarantees. That effort reached a turning point after Franklin D. Roosevelt took office in March 1933. His national banking holiday shut down banking transactions, including the Federal Reserve, while examiners reviewed banks for reopening. It was an extraordinary measure, but it addressed a basic problem. If people no longer knew which banks could be trusted, the government would try to create a process by which trust could be publicly restored. The Emergency Banking Act was introduced on March 9, 1933. 3 days later, on March 12th, Roosevelt delivered his first fireside chat. The importance of that address was not only in the policy it explained, but in the relationship it tried to rebuild. Roosevelt spoke to a public that had learned, painfully, to doubt institutions. The task was to persuade Americans that reopening banks were not simply unlocked doors, but examined institutions that could again hold deposits with credibility. That same year, federal deposit insurance was enacted through the Banking Act of 1933, also known as the Glass-Steagall Act. Deposit insurance mattered because it changed the psychology of banking. It gave ordinary depositors a reason not to run at the first rumor of trouble. It did not erase the losses already suffered, and it did not undo the long contraction by itself. But it addressed one of the central failures revealed by the Depression. Without confidence in deposits, a banking system could turn fear into collapse. Looking back to the first week of the crash, the connection becomes clearer. Black Thursday, Black Monday, and Black Tuesday did not contain the whole Great Depression. They did not begin the downturn, and they did not immediately produce the later banking panics. But they exposed the fragility of confidence in a modern financial system. They showed how quickly belief could change, how prices could fall faster than reassurance could catch them, and how public trust, once broken, could not be easily commanded back into place. The first week was a beginning in memory more than in chronology. The Depression's economic contraction had already begun in August 1929. The most severe banking panic came later. The deepest market low came in the summer of 1932. The formal repairs came in March 1933 and after. The recovery of stock prices to pre-crash heights waited until November 1954. But history often turns on moments that reveal what was already vulnerable. The late October panic revealed a country whose prosperity had become entangled with speculation, credit, leverage, and belief. When that belief failed on Wall Street, the consequences did not stop at the exchange. They traveled into banks, into lending, into money itself, and finally into the relationship between citizens and the institutions that promised safety. The repair, when it came, was not simply a return to the past. It was an admission that confidence had to be supported. Bank examinations, emergency authority, public explanation, and deposit insurance were all ways of answering the same question that frightened depositors had asked with their feet: will my money still be there when I need it? The Great Depression's first week did not end when the market closed on Black Tuesday. It continued as a memory, as a warning, and as a lesson in the cost of broken trust. Its deepest meaning was not only that prices can fall, it was that confidence, once lost, can take years to rebuild, and that a financial system is held together not just by numbers on a page, but by the public's belief that promises will be kept.